Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through the market noise. Today, we are not just looking at a stock, we are taking a sledgehammer to a massive private equity deal. We're going to deconstruct it piece by piece, right down to the foundation, so we can all understand the blueprint. The company? Oh, it's one you definitely know, even if the name doesn't ring a bell. And the buyer? They are one of the sharpest, most disciplined firms on Wall Street. All right, let's get our hands dirty. So let's start with the big, flashy number right up top, $10.3 billion. And to be clear, that's the enterprise value. That isn't just the stock price, that's the whole shebang, the company plus all of its debt. Think of it like buying a house and also agreeing to pay off the existing mortgage. The private equity firm Clayton, Dubilier & Rice is shelling out this cash to take Sealed Air Corporation completely private. This isn't some small-time acquisition, this is a heavyweight industrial player. A number this big isn't just a headline, it's a statement. And it demands that we grab our tools and inspect every single nut and bolt of this entire structure.
Okay, let's just stop right there for a second, because that is the question, isn't it? Sealed Air. You know them. They make bubble wrap, the stuff you can't resist popping. And Cryovac, the vacuum-sealed plastic that keeps your groceries fresh. It's a good business, nobody's denying that. But $10 billion with a B for a company in an industry that's known for being tough, competitive, and cyclical? You have to ask yourself, is CD&R a bunch of geniuses who found a diamond in the rough, or are they just massively overpaying for a glorified bubble wrap factory? Is this real strength, or is it just hype? That's exactly what we're here to find out.
Exactly. And to get to the bottom of it, we need a plan. We need a blueprint. So here's how we're going to attack this explainer. First, we're going to lay out the high-level details of the deal itself. You know, the who, what, where. Then we are going deep, inspecting the very foundation of Sealed Air's business. After that, it's time for the financial stress test. We're going to drill right into the numbers that convince the banks to write the checks for this thing. From there, we'll get into the private equity renovation plan, how CD&R is going to rebuild this company to make it even more profitable. And finally, we'll reveal the final blueprint, our verdict on whether this deal is built to last.
All right, Section 1, the deal. You can't analyze the structure until you know who's building it. So let's take a look at the key players, the price they agreed on, and the whole point of this massive transaction in the first place.
So you've got two main players on this job site. First up, the buyer, Clayton, Dubilier & Rice, better known as CD&R. Now, these aren't your typical Wall Street speculators. These guys are operators. They've got deep experience in the industrial sector. They buy companies to run them better, plain and simple. They're known for rolling up their sleeves and doing the heavy lifting. And on the other side of the table, you have the target, Sealed Air. This is a big, publicly traded company on the New York Stock Exchange, ticker SEE. They're a global force in packaging for food and other goods. So let's be clear, this isn't some failing business on the brink. This is a major established corporation getting a new owner. Now, a lot of details here, but I want you to focus on one key outcome. Sealed Air is being taken private. It's an all-cash deal, which tells you CD&R is serious. They're putting real skin in the game. But the most critical part is that Sealed Air is going to be delisted from the stock exchange. It's leaving the public stage. And that right there is a huge piece of this puzzle. Why would a successful, profitable public company want to do that? Why would they want to retreat from the public eye? See, when you're public, you have access to tons of capital, but you also have to answer to thousands of different shareholders every single quarter. By going private, they now answer to just one owner, CD&R. That gives them a ton of freedom, but it begs the question, what are they planning on doing behind closed doors that they couldn't do out in the open?
And that's the perfect lead-in to our next section. To really get why CD&R would pay $10 billion for that kind of freedom, you got to check the foundation of the company itself. You know, you would never start a massive renovation on a house that has a cracked foundation. So what is Sealed Air actually built on? Let's go check the structural integrity. And this image right here explains the core of their strength. It is the classic razor and blade business model. Think about it. Sealed Air doesn't just sell you a roll of bubble wrap. No. They sell, or often they'll just loan, specialized packaging equipment to their customers. Once that expensive machine is sitting on a factory floor, it needs to be fed. And guess what? It's a very picky eater. It only consumes one thing, Sealed Air's own proprietary high-margin packaging materials. This creates what we call customer stickiness. Once you're in their system, it's incredibly difficult and expensive to leave. This gives them immense pricing power. So this isn't just about selling a product, it's about creating an entire ecosystem. That is a foundation made of steel-reinforced recurring revenue.
Okay, that model sounds impressive, I'll give you that. But let's stress test that foundation a little, shall we? Take a look at this chart. This is the entire global packaging industry. You see the giants in there, right? WestRock, International Paper, they've each got a nice big slice of the pie. Now, look for Sealed-Air. You see them? All the way down there, with a tiny little sliver, just 1.73% of the total market. So if this foundation is so rock solid, why are they such a small player? To me, that looks less like a fortress and more like a little guard tower in the middle of a massive battlefield. Are we sure this is really a powerhouse?
See, that's where you're looking at it the wrong way. This isn't about a land grab. This isn't about trying to dominate the entire map. A private equity firm like CD&R couldn't care less about those vanity metrics. What they care about is cash flow. Cold, hard cash. The key is that Sealed-Air owns an incredibly defensible, cash-generating niche inside that giant industry. They absolutely dominate specific high-margin areas like fresh meat packaging. Their tiny overall market share? It's totally irrelevant. What matters is that their little piece of the pie is wildly profitable and protected by a deep moat, that razor and blade model we just talked about. CD&R wasn't looking for a fixer-upper that needed to be saved. This isn't a teardown. They found a building with a perfect foundation, one that was just begging for a high-value renovation.
Which brings us right to the numbers. Because a private equity firm might fall in love with a story, but they only write a check based on the math. So now it's time for the financial stress test. We're about to drill down into the very documents that CD&R and Sealed-Air showed the banks, the people who actually have to lend them billions of dollars to get this thing done. This is the real story, pulled directly from their 8K filing with the SEC. For those who don't know, that's the official report companies have to file to announce huge events, like this one, to shareholders and the public.
Now, before I show you the actual table, you have to understand the single most important number in any leveraged buyout. It's called Pro Forma Adjusted EBITDA. Now, this is not your typical everyday net income number. Think of it as the company's core earning power, its engine, but with some, let's say, creative modifications. It starts with regular earnings, then it adds back stuff like interest, taxes, depreciation. But here is the secret sauce. For a deal like this, they also get to add back expected future cost savings. I want to repeat that. They are literally showing the banks what the company's earnings will look like after the renovation is done. It's a forward-looking number designed to show just how strong the company can be, and, more importantly, how it's going to handle the mountain of new debt they're about to take on.
Okay, now look at the table. This is the math that unlocks billions of dollars in financing. Let's walk through this step by step. We start at the top with net earnings, $441 million. That's a solid number, but just watch how it grows. First, they add back the standard stuff, interest, taxes, depreciation, and that gets them to a normal EBITDA of $944 million. Then they make a few more adjustments for one-time costs. But here, look at these last two lines. This is where the magic happens. They add $6 million in savings just from no longer being a public company, not having to print fancy shareholder reports and things like that. And then, the big one. They add another $125 million in future cost saves. And just like that, a $441 million net income magically transforms into a 1.3 times billion-dollar pro forma EBITDA. That number, right there, is the key that opens the bank's vault.
Whoa, hold on a minute. This feels a little like building with phantom bricks, doesn't it? They're adding $131 million in savings that haven't even happened yet? They're basically getting a massive loan based on a promise. Isn't this just a fancy term for financial engineering? It just seems incredibly aggressive to bake in potential future savings and present them as part of the company's current financial strength, all to justify piling on more debt. How do the lenders even sign off on something like that? What happens if those savings never show up?
That is absolutely the right question to ask. But here's the counter-argument, and believe me, it is a powerful one. Take a look at what Sealed-Air was already doing on its own, before this deal was ever even a whisper. In the year leading up to this, they were already fortifying their own balance sheet. They cut their net debt from $4 billion down to $3.7 billion. And even more important is their net leverage ratio. That's a key measure of debt compared to earnings. It was already getting better, dropping from 3.6 times down to 3.2. This proves that management wasn't just sitting around waiting for a buyer. They were already doing the hard work themselves, and that tells CD&R, and more importantly the lenders, that this management team is disciplined and knows how to execute. It makes that promise of $131 million in future savings a much, much lower risk bet. They were already reinforcing their own foundation.
And that brings us to the renovation itself. We've inspected the foundation, we've stress-tested the finances, so now let's open up the CD&R playbook. How exactly are they planning to unlock that $131 million in value and turn this thing into an even more profitable, more efficient machine?
What you're looking at here is the classic private equity buyout blueprint. It's a time-tested 5-step process. Step 1. Find and acquire a stable, cash-generating company. Check. We already saw that with Sealed Air's razor and blade model. Step 2. Take it private to get away from the pressure of hitting quarterly earnings numbers. Check. But now, look at steps 3 and 4. Implement aggressive cost-saving programs. Sound familiar? That's the $125 million we just saw in the EBITDA table. And eliminate public company costs. Yep, that's the other $6 million. This isn't some secret formula. The numbers they showed the banks are a direct reflection of this exact playbook. The final step is to re-engineer the whole business, not to make a better product necessarily, but to build a better cash flow machine, one that can pay down all that buyout debt and generate a massive return for CD&R.
Okay, I get the playbook, but this timeline just brings me back to the same question. Look at this. In 2018, Sealed Air launched their own program called Reinvent CE, and it worked. It generated $87 million in benefits. Then in 2023, they launched version 2.0, and they were already targeting another $140 to $160 million in savings. So they were already doing it. They were already renovating their own house. What actual value is CD&R bringing to the table here if they're just going to execute a plan that management already came up with? Why do they get to pocket all the profit?
Because it all comes down to two things: speed and intensity. Think of a public company as a high-performance engine, but it's got a governor on it that limits its top speed. That governor is the constant need to please public shareholders every single quarter. You can't just shut down a factory or make deep, painful cuts if it means you're going to miss your quarterly earnings number and get hammered by Wall Street. CD&R's role is to come in and just rip that governor right off the engine. As a private company, management suddenly doesn't have to worry about short-term market reactions anymore. They can make the tough decisions, consolidating factories, streamlining their supply chain, making targeted layoffs, much faster and more aggressively. CD&R isn't bringing a brand new plan. They're bringing the high-octane fuel and, more importantly, the permission to execute the existing plan at full throttle.
Okay, time to bring this all home. Let's get to our final section. We've walked through the entire blueprint, from the foundation all the way up to the renovation plans. So, what's the final verdict? When all the dust settles, is Sealed Air going to be a fortified structure? Or is this entire $10 billion deal just a house of cards built on a foundation of debt and promises?
Our verdict is pretty clear, and this quote really sums it up perfectly. This is not a rescue mission. CD&R did not buy a failing company that was riddled with cracks in its foundation. They bought a strong one. This is a strategic acquisition of a solid, durable, cash-generating asset that was already in the middle of improving itself. CD&R simply saw an opportunity to take a good structure and re-engineer it to be great, far away from the prying eyes and short-term demands of the public market. The potential was already there. They're just the catalyst to unlock it at a much faster pace.
And if you need any more proof that the underlying foundation here was solid, just look at this chart. This shows Sealed Air's earnings per share surprises for 2025, the year right before the buyout. In the first quarter, they beat Wall Street's estimates by almost 21%. In Q2, they beat by over 23%. And in Q3, they beat by a staggering 26%. A company that is consistently crushing expectations like this is sending a clear signal to the market that its own internal improvements are working. This is not a company that's in trouble. It's a well-oiled machine that's gaining momentum. For a buyer like CD&R, that isn't a risk, it's a giant green light. This consistent outperformance is exactly what gave them the confidence to write a $10 billion check.
So, the final blueprint is clear. Sealed Air has a rock-solid foundation, a proven ability to execute, and now, under private ownership, it has the freedom to accelerate its own transformation. It's being rebuilt from the ground up for private profit. And that leaves us with one final, and I think, provocative question. This playbook, find a stable, cash-generating public company that's already trying to improve, and then take it private to speed up the process, it's incredibly powerful. It clearly worked here, so the question for all of us watching the market is this: which publicly traded industrial giant is next on the drawing board? That is the kind of analysis that forges a stronger portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.